Let's go. So guys, as we just said, this is all about the intersection of crypto and insurance. Not only on how crypto can insure itself, but especially how crypto can be used as collateral for insurance. So it's about insurance within crypto, but outside of crypto. Our panelists have already been introduced. We don't have a lot of time, so I want to get straight into some questions. First round table. What is one risk in crypto that's keeping you up at night?
Yeah, I think one big risk is the use of multi-sigs in DeFi. What they have ownership over proxy contracts or managing funds. And then there's a basic level of operational security that we've seen. It has not been followed. There is no standard DeFi that's being followed. There's a lot of progress being made on this front, but that has been a leading cause of loss in DeFi to date, and it is a big hurdle that we need to get over. So that's the biggest one in this new.
Nice. Dhruv?
Hello, GM. Okay, it's working. For me, it's rise of RWAs because most of the RWA risks are off-chain. They are not very transparent. And to be funny, most of these RWAs closes in weekends, not like us. We are 24/7, 365 days. So that's keeping me at night.
Interesting.
Well, thanks, guys. Now I have more reasons to stay up. I think for me, like after this balancer hack, which there's this meme in crypto that if a smart contract's been operational for a long time, it's battle tested, we should assume that it's safe. This kind of opened up my eyes to potentially other contracts being compromised, and I think the one that everyone's probably the most fearful of would be Aave. So I think if Aave were to be compromised, it would be catastrophic for the ecosystem.
Interesting. Some people have called it the risk parade, and I think they're right in saying that. Can you briefly share what all of you guys are working on in the insurance space?
Yeah, we're doing quite a few things at Nexus. One of the big things is tapping into some average staking capital, to extensive more coverage, working on sourcing and working capital within the mutual itself. We are working on some new cover products, one of which I'm working with Seal on developing, is for multi-staking operation of family cover. We are working on some things in the regulated insurance space, where the regulated cells and out of Nexus. And then the key one, we're launching a real world insurance vault that offers a baseline yield and allocates capital to reinsurance markets and traditional markets. Quite a few things.
That's true.
So we are on-chain infrastructure for insurance. Think of us as marketplace for crypto native. Think of us as marketplace for crypto native or traditional insurers who come on-chain and tap in digital assets backed by symbiotic. And yeah, that's it.
Sebastien?
I feel like I'm a bit of a black sheep here because we're not actually working in insurance, but we're a venture fund, and a lot of the driving thesis behind the investments we made is investing in protocols that are transparent, offer transparency, because I think that that's like a very important ethos and an important reason why crypto exists is that we have things that are on-chain that are auditable, and as we've seen in the last couple of weeks, and certainly like this is not new. There's a lot of on-chain assets that carry off-chain risk that we need to be more conscious of and be aware of when interacting with DeFi.
Yeah. Going to the longer form questions, like one thing that's definitely been making a lot of noise lately is all of the explosions that have happened the past 2 weeks. So I just want you guys to talk a little bit about this and what you think the ecosystem has learned and how we can avoid that in the future.
Yeah, so if I could just give a quick tail on some of these exploits or roll-up events. One of the ones that Sarah talked about was the balance chain 2 exploit. There was a rounding error that was exploited in the composable pools, composable stable pools at Balancer V2. Balancer has been around for a long time. There's Balancer V1, Balancer V2 launched 5 years ago, and then there's Balancer V3, which launched last year. So that exploit caused a loss of about $120 million in balance sheet too. The balance sheet team did all the right things. They had a $5 million bug bounty. They had multiple audits. They had great security practices, balancers of more complicated debts. People seem to think that if protocol's been around for a long time, that it's safe to use, but you can never get risk down to zero on anything, especially in on-chain markets. Unfortunately, nobody got covered for this thing because they thought it was safe. And, people have been shifting over to balance sheet V3, and we saw this great big loss. Very unfortunate. So that's on the one side of the smart contract exploits, which we are seeing some trends downward in smart contract losses and trends upward in things related to lending markets, things related to multi-sig operational failure. Then you get the stream finance contagion risk, basically. From the stream finance, for those of you who don't know, was a yield protocol. Mainly it was people managing funds between EOAs, multi-sigs, and then managing funds on exchanges. I described it as a hot wall of risk because that's what it was. It was a very degen strategy where people were allocating funds to risky strategies, levering up on their own vault shares internally, so rehypothecating their vault shares or doing things that were, from my point of view, you could not cover. A lot of risk carriers in the space allocated lending capital to the XUSD markets within sort of traditional lending markets like Euler and Silo and Morpho. Because of that, utilization in those markets was 100%. People can't withdraw. They used fixed rate oracles that didn't track the marketplace. And so when the token DPEG, when they announced their impairment, was $93 million, which is a good chunk of money in the overall fund that Stream Finance had, those liquidations didn't occur in those lending markets. For those of you who aren't super familiar with DeFi lending markets, oracles are what trigger the liquidations. If there's a drop in the price of the collateral, a liquidation occurs. If you use fixed rate oracles, you can avoid things like secondary market DPEGs that occur because people are trying to get out if there are redemptions. But if there's a fixed rate oracle that is tracking the price and then a DPEG significantly because of something that happened with Stream, now you have a situation where liquidations don't occur and you have bad debt. This is something that we'll pay out some claims for, but this contagion affected multiple projects. Elixir, Stable Labs, and a lot of curators in the permissionless lending market space. So what have we learned from this stuff? Well, apparently nothing yet on the contagion thing. The big thing that we need to do from the protocol team and the curator side is people need to do due diligence. Somebody asked us to cover this, like I said, 5 months ago, and I just said there's no way we can cover this. It's just, you can't cover this kind of risk. There's no transparency in what's happening. I think if people would have done the necessary due diligence, they wouldn't have created these markets. If they would have looked inside the screen and seen that they were rehypothecating their own vault share tokens. And that didn't happen, and now there's been a really big impact across this period. There's probably around 238 million in exposure across all these lending markets. I think that we need to see a bigger push for transparency from teams. I think people that are allocating capital, whether it's funds or retail users, need to demand their transparency and not allocate funds there. And the biggest thing is if you don't know where the yield is coming from, the mantra in the OG crypto space is you are the yield. And in this case, that was true. So I think that we need to do a better job on the protocol side, on transparency, and then we need to stop giving money to people that are just managing things in a very centralized way because that goes against the ethos of what we're building in DeFi.
Absolutely. Dhruv, do you have anything to add?
Mostly, Lee has covered everything, but I would like to double click on the yields. If you see 18 to 20% yields on stables, it should raise an alarm. Seems like we haven't learned anything from Luna crash. And it was pretty evident that they were insolvent from day one. They were looping their own vault shares. So 18 to 20%, it's unsustainable in these days for stables. So yeah, we need more transparency, more credit ratings, more ratings on dashboard for retail users. Yeah, that's the name of the game.
Yeah. Sebastien, I'm curious from the investor's perspective, like, do you think events like this, like scare off capital a lot? We've definitely seen a big risk off move from capital allocators. Like, do you think like we should like expect like a much smaller appetite for risk on chain, or do you think it's just changing the behavior of people allocating on chain?
I mean, like we started raising our fund the week after FTX collapsed. And so I've seen, the LP and investor appetite and institutional investor appetite for early stage crypto, specifically, from where we sit as an early stage fund. And I can't say that there's been much of an uptick, from the LP perspective. I think a lot of VCs also have found it difficult to raise, say compared to like previous cycles. And so, yeah, I mean, I think, Hasu, I think tweeted about this where he said that, every time something like this happens, it sets DeFi back 6 to 12 months. And I think that's true. It does create a lot of fear and a lot of uncertainty. I mean, if we in DeFi can't even track this risk, how do you expect sort of institutional LPs and people who are, entrusting us as professionals in the ecosystem to be doing our jobs right? It's very difficult. There's a quote there's an article in The Economist from 2013, which I kind of come back to, and it's titled Crash Course. And there's a quote in that article. This article came out 5 years after the 2008 financial crisis, and so it was meant to be sort of a retrospective. And there's a quote in this article that I really love, and I keep using it again. I put it in decks, and stuff. Like, it's just something that I've got pinned. And it goes, half a decade's worth of hindsight. Geez, I had practiced this, but with half a decade's worth of hindsight, it seems that the cause of the collapse was clear. The most obvious were the financiers themselves, especially the irrational, exuberant Anglo-Saxon sort who thought they had found a way to banish risk, but simply had lost track of it. And I think it's such an important, we have so many lessons to learn from what happened in 2008 in crypto, and there's just this just resonates with me as, sort of very exemplary of just what's happening. There's greed, people lose track of the risk, they don't really sort of know where this yield is coming from. Retail investors look at this and they're like, this is great. Funds look at this, this is great. We can probably ride this for a while until they can't. And then we all think we learn lessons, but in fact, I don't think we have. So I think the takeaway here is we need to actually implement things that sort of prevent this, right? Where we actually do learn the lesson and try to fix things moving forward.
No, it makes a lot of sense. And I think with DeFi TVL booming right now, we should definitely implement just better common sense. But also one thing we should be seeing, and I guess we haven't seen to the scale that we want to see at the moment, is just the huge raise in cover, in underwriting for these risks. From your perspective, Lee, what do you think is the biggest hurdle, the biggest constraint for why this hasn't scaled so far?
I think there's a couple of things. When Nexus originally launched in 2019, so I would say from 2019 to 2022, you had a lot of different people operating on chain, but you had a lot of people that are referred to as degens or degenerates, right? So those people, their view of risk management is allocating capital across 200 protocols. And if any one blows up, it's not a big portion of their thing. But for retail users or funds, they're not going to allocate to 200 protocols. They're going to allocate to higher quality strategies. But funds have an obligation to their LPs to provide cover, so if there is a loss, they can absorb that and they have coverage, right? That's how it works in traditional finance. Retail users also want to buy cover, but it's harder for them to understand risk. So we've made great strides in improving that. But still, that market is not as big. It's gotten bigger as more institutions have come in. One thing that we hear is that the cost of cover is too high, that it should be lower, 50 basis points, which is not the probability of loss for some of the different protocols in DeFi. Because people look at it as how much can they earn in yield and how much is the cost, that's one friction point. Again, that's gotten better over time as we've gotten more data and improved our actuarial models. But a big thing is you have to scale demand for coverage with the capital that backs it. So those two things scale in unison. And we're now at a point where we're seeing demand that outstrips the available capacity in DeFi. So that's how we can tap into restaking capital. We can scale those things up together. But you have to have both the underwriting capital and the distribution, the demand for coverage. And we're just starting to see that now here in the last couple of years.
Super interesting. Dhruv, do you have anything to add?
So, as you mentioned that DeFi TVL is 0.5% covered now. I would say that's mostly because DeFi has been retail driven, as Lee mentioned. Now, for the past 1 year, we have familiar, friendly regulations. Institutions are coming on chain, and that's where we need coverage. Retail doesn't care about coverage. They need APY. They need, these guys are degens. They play with meme coins. They play on perp dexes with high leverage. So it's pretty evident that coverage demand is rising day by day exponentially for the past 1 year, and it will rise a lot for the months to come. So that's the major reason why coverage hasn't scaled with the DeFi TVL.
Got it. But I mean, Sebastien, maybe I can ask you this question, but like I don't think it's necessarily like super fair to just like segment crypto into huge degens that have like no aversion for risk and institutions that are very risk averse. Like I personally wouldn't want my funds to be to be at a high risk, similar to what we've seen recently. Like, do you think there's like a middle ground that like people can tap into?
Well, I think in this case, whatever curators were, had these assets on like more for markets, like they didn't do their job, right? I mean, like their job as curators is to curate, or at a minimum be transparent with their users about where the yields are coming from, and I don't think they did that. I think they offer these products, users see a yield, say this is great, but they're not very transparent. They weren't very transparent. I mean, like, you couldn't be, right? Because as you mentioned, Stream was not transparent about where this yield was coming from. So I think there's a question of reputation and trust that, like, should we trust these curators in the future? Should we continue to sort of like allow them to lead, to be like market leaders and capture like an enormous amount of fees from TVL on lending markets? So I think that's one thing. I think like the industry and sort of people who are serious about building this project of crypto markets, need to be honest with themselves about like, who are we trusting in the ecosystem? I mean, the entire point of crypto is like to be trustless. If these people aren't trustworthy, if these curators aren't trustworthy, then we shouldn't give them our trust in the future. One thing, and I think also that ecosystems or even DeFi protocols by and large should be perhaps even more careful about which asset they permit. Now, this could be through governance, of course, but much more responsible about which assets they permit on their markets, because an asset that is just a representation of some, like off-chain strategy where you have no idea of what's being done with that money, it's not really DeFi. It's like CDFi or whatever. But like, there's a problem with, I think, what we're actually calling these things and like what that means to people who are investing yields in them, and it's just like dishonest. So I think we all need to kind of like take a step back and like maybe ask ourselves the questions, are these things really the types of products that we want on our protocols, like generating yield or interacting with, when they're not actually decentralized or transparent?
And that's completely fair. Dhruv and Lee, you both talked about the use of restate capital, of like capital on Symbiotic as a way to underwrite like more covers. Can you talk a bit about like the effect that has on access to capital for you guys, and what it could mean for the cost of capital for people that want to underwrite your covers?
Yeah, so if you have underwriting capital and you're allocating to somebody, first you want to make sure that they have decent underwriting standards and they actually know what they're doing. Again, this goes back to Seb's comment on curators. People can say they know what they're doing, but if they don't have a good track record, then you obviously don't want to allocate capital to them. It really depends, as far as like what the expected yield is, it really depends on what covers you're underwriting with the restaking capital. If you look at some examples on Nexus, if you look at our underwriting pools that we have and what the APYs are, they range anywhere from 2% to like in the 20% range, right? It depends how much capital is in the pool and how much cover they're underwriting. With our model at Nexus, it's based on how traditional insurance is set up, where you can underwrite multiple lines of business, you manage the risk, and because you're able to underwrite multiple lines of business with the same capital, you're able to amplify your yields. And this is where risk management comes into play. But with this, you can earn, fairly high yields. If you start out with a smaller strategy, maybe you're earning somewhere between 4 to 6% APY. But as that evolves out, as cover demand grows, you can get a very attractive yield in the 10 to 20% range if you're doing good business. So it can be very high. It just depends on how much cover you're underwriting. That's why the demand portion is so important.
Do you have anything to add?
So why restaked assets are lower cost of capital? That's the question, right? Because restaked assets already have built-in staking in place, which already offers 2 to 3% returns. So on top of it, if we are using restaked assets as underwriting capacity for insurance, comfortably scales to 10 to 15%. I would say on the conservative side, it's 4 to 6%, but we can easily scale it to 10 to 15%. And we have rehypothecation of uncorrelated risks or negatively correlated risks. Yeah, there can be very, very interesting APYs. And that's sustainable. That's not degen looping APY of stream finance.
Yeah.
Yeah.
And I mean, you also have the important part, which is like those risks have to be like uncorrelated. Like if you're going to provide economic security for like a network, it has to be, the slashing risk has to be uncorrelated with the cover that you're going to underwrite, or like the risk you're going to cover on DeFi. I think it's definitely like something that's super important. And like as you're saying right now, like with the growth of the demand side, you need the supply side to back it up. So that's definitely something that's interesting. Like, and I'm guessing we're talking about Ethereum LSTs right now, like maybe Bitcoin derivatives. How far can the threshold for the quality of the asset be in terms of collateral for underwriting? Like, can we go to, could we use like yield-bearing stables? Like, what is like a good like threshold that we shouldn't go beyond?
I think one big thing is when you're looking at the quality of assets, you need a certain amount of liquidity, right? Because what are you underwriting? What's your cover denominated in? Is it mostly stables? Is it BTC? Is it ETH? Like, you know, what is it? So if you're underwriting a lot of coverage in stables, you're going to need to swap out of the ETH when you slash it and into stables to meet your obligations when there are payout events. So liquidity is a very big part. So you want something that's a higher market cap with a lot of liquidity so that it's very liquid and you can swap in and out to meet demands when there are claims. You also want something that has some track record that doesn't have a lot of inherent risk. LSTs are a natural start because they have a very low risk profile in general, right? They still have some risk, but it's relatively low because the risk is basically slashing. So you have assets like that. You can get into some yield-bearing stables, but again, you want to be careful because if you have some yield-bearing stables that you're using to underwrite, a lot of times those are also going to be correlated to the risks you're underwriting. So you don't want that because you can't underwrite, let's say, coverage for Athena when your backing capital is USDE or SUSDE. So you have to be very careful about that. You want low risk assets in there. And it does provide a base level of yield, which is important. I mean, that's what we do at Nexus with our capital pool. It's mostly invested. But you have to make sure that, one, your underwriting capital that's backing the covers doesn't suffer a loss and impairment itself. And two, that you're able to meet your obligations. So a lot of it is up to the person that is managing the risk. So in this part for Nexus, it's managing that asset liability so you have enough to cover the risks if you have a payout.
I would say only blue chip assets, nothing else. So ETH LSTs, I would say only the top 3 blue chip ones because I don't want to play with the DPEG of LSTs if I'm using it for underwriting capacity. And similarly for BTC derivatives and nothing else. Because if I'm using yield-bearing stables, there is a counterparty risk, there is a DPEG risk for those stables. So it will be very much correlated with the risks I'm underwriting. So yeah, only blue chip.
I mean, I think like that makes sense directionally, but then the definition of blue chip may evolve over time. And I think it just comes back to like, you know, as an ecosystem, and certainly like DeFi protocols need to be very upfront and transparent about what are the risks that their users are entering into when allocating to certain vaults or certain stable coins or yield generating instruments. And we have the opportunity to do this if the assets themselves are like fully on chain, the yields are coming from the chain, and we have that on chain traceability. Like I think there's an opportunity for protocols and like lending markets, et cetera, to have really clear UIs that like show you what the risks are, show you what your underlying risks are, what bridge risks you might have, what yield sort of like underlying collateral risks you might have, and thinking that like retail users are not able to like comprehend or digest this information, I think is kind of undermining the intelligence of the people that we serve, and like we just need to be much more transparent and upfront. Like I think that's let people make their own decisions as long as they're informed, I think is the most important thing.
I think on that, I don't think it's just retail. I think risk is very hard on chain. It's hard for anywhere from funds to retail users to understand it. And it's our job as underwriters and it's protocols' jobs to make it clear what the risks are and ways to mitigate those risks.
Agreed. Guys, we're right on time. What is one bold DeFi insurance prediction for 2026?
I mean, I think we'll see more blowups for sure, but that happens every year, right? I think one of the big things, we're going to see a bigger trend to RWAs, and then that comes to the Oracle risk aspect that we've talked about with fixed rate oracles and things, I think there will be a large loss event here in the next year related to RWAs in lending markets.
Yep, totally. RWAs. So Catalysis will be covering RWAs in 2026. Look out for Catalysis.
I don't have a specific insurance prediction, but I think it's possible that there are more dead bodies that surface from this October 10th thing, right? Like, you know, there's been some that have surfaced, but there might be some others that are kind of hiding that will show up at some point. And yeah, unfortunately, I hope we learn our lessons from this whole episode.
Very scary. I hope we don't like suffer like a Terra Luna, like. Well, thanks for listening, guys, and we'll be starting the next panel pretty soon.